I have spent over 50 years studying market bubbles, and I have never seen anything quite like what is happening right now in 2026. The everything bubble we warned about for years finally burst in late 2024 and early 2025, and most investors are still in shock. The S&P 500 dropped 38% from its peak. The Nasdaq fell 52%. Real estate values collapsed in major cities. Crypto imploded again. And now, as we sit here in January 2026, most people are terrified to invest. They are sitting on cash, waiting for things to get better, hoping for clarity, praying for safety. And that is exactly why this is the greatest buying opportunity I have seen since 2009. Maybe since 2002. But here is the problem. Most investors will not act. They will wait until the market recovers, until stocks feel safe again, until everyone is buying. And by then, the opportunity will be gone. The stocks I am about to tell you about will have already doubled or tripled. So if you are watching this in January or February 2026, you are early. You are in the small group of people who might actually profit from this crisis instead of just surviving it. And if you are serious about building wealth during this downturn, if you actually want to buy when there is blood in the streets, as the saying goes, then what I'm about to share could be the most valuable 40 minutes you spend all year. Because I am going to tell you about 2 stocks. Just 2. If I could only buy 2 stocks in 2026 with my own money, these would be the ones. Not 10 stocks, not a diversified portfolio of 30 names, just 2. And by the end of this video, you will understand exactly why these 2 companies represent the single best risk to reward opportunity in the market right now. Let's start with the reality of where we are. The crash of 2024 and 2025 was not a surprise to anyone paying attention. We had been warning about it for 3 years. Valuations were insane. The S&P 500 was trading at 32 times earnings in late 2023. That is higher than 2000. That is higher than 1929. The only time it was worse was the peak of the dot-com bubble. And everyone said the same thing they always say. This time is different. AI will change everything. The Fed has our back. Stocks only go up. We heard it all before, and we will hear it all again in the next bubble. But it was not different. It never is. The bubble popped. The market collapsed. And now we are in the aftermath. Here is what most people do not understand about market crashes. The crash is not the opportunity. The crash is just the setup. The opportunity comes in the months after the crash when fear is still dominant, when most investors are still paralyzed, when valuations have normalized but sentiment has not. That is where we are right now in early 2026. Stocks are cheap by historical standards. The S&P 500 is trading at 14 times earnings. That is below the long-term average. But nobody wants to buy because they are scared. They remember losing 40% of their portfolio. They are worried it will drop again. They are waiting for a bottom that already happened 3 months ago. If this resonates with you, hit that like button right now. So here is what I would do if I were starting fresh today with money to invest. I would not try to buy 20 different stocks. I would not diversify across every sector, hoping to capture a little bit of everything. I would concentrate. I would find the 2 best opportunities in the market, and I would go deep. Why only 2 stocks? Because concentration builds wealth. Diversification protects wealth. If you already have $10 million, sure, spread it across 50 stocks and sleep well at night. But if you are trying to build wealth, if you are trying to turn $50,000 into $500,000 over the next decade, you need concentration. You need to be right about a few great companies instead of mediocre about many average ones. Warren Buffett made his fortune with concentrated bets. He owned 6 stocks in the 1960s when he was compounding at 30% per year. Peter Lynch said if you own 20 stocks, your 20th best idea is probably not very good. And I have been doing this for 5 decades, and I can tell you, the money I made came from a handful of great decisions, not from spreading my bets thin, So 2 stocks. That is the plan for 2026. Let me tell you what I am looking for. I want companies that are essential, not optional. I want businesses that provide something people and governments and corporations cannot live without, even in a recession, even in a depression. I want companies with pricing power. When costs go up, they can raise prices without losing customers. That is the ultimate business advantage, especially in an inflationary environment like we are seeing now. I want strong balance sheets, no debt bombs waiting to explode, no financial engineering, just clean, simple, profitable businesses that generate cash. I want long-term secular tailwinds. I am not trying to trade a 6-month rally. I want to own these stocks for 5 years, maybe 10, and I want to know that the world will need what they sell more in 2030 than it does today. And finally, I want valuation. I do not care how great a company is if I am paying 50 times earnings for it. I want to buy quality at a fair price, or better yet, quality at a cheap price. Those are my criteria, and in the entire market right now, 2 stocks meet all of them better than anything else I can find. Let me tell you about the first one. The first stock I would buy in 2026 is a company most people have never heard of, but it is one of the most important businesses in the modern world. It is called Nutrien, ticker symbol NTR. Nutrien is the largest producer of potash in the world and one of the top producers of nitrogen and phosphate fertilizers. And before you tune out thinking fertilizer is boring, let me explain why this is the single best stock you can own for the next decade. Here is the simple truth. The world has 8 billion people. By 2050, we will have 10 billion. Those people need to eat, and the only way we feed 10 billion people is with fertilizer. There is no alternative. Organic farming sounds nice, but it cannot scale. We would need 3 times as much farmland to feed the world without synthetic fertilizers, and we do not have 3 times as much farmland, so fertilizer is not optional. It is essential. And the companies that produce it have pricing power that almost no other industry can match. When food prices go up, farmers pay more for fertilizer because they have no choice. When crop prices are strong, fertilizer demand stays strong. And even when crop prices are weak, farmers still need to fertilize their fields or their yields collapse. Now, here is where it gets interesting. Potash, the main product Nutrien produces, is a unique commodity. There are only a handful of places in the world where you can mine it economically. Canada, Russia, Belarus, and a few smaller producers. That is it. You cannot just start a new potash mine. It takes billions of dollars and a decade to develop a new deposit. So supply is constrained. And demand is growing. Every year, more people, more mouths to feed, more fertilizer needed. The supply-demand equation for potash over the next 20 years is about as bullish as any commodity I can think of. Let me give you the numbers. Right now, Nutrien is trading at around $48 per share. The stock peaked at $120 in 2022 before the broad market sell-off. At $48, the company is trading at 8 times earnings, 8 times, for a company with a virtual oligopoly on an essential global commodity. For context, the average stock in the S&P 500 is trading at 14 times earnings. Nutrien is trading at almost half that multiple for a business with better economics, better long-term growth, and better pricing power than most of the index. The company generates about $3 billion per year in free cash flow. At a $25 billion market cap, that is a 12% free cash flow yield. You are getting paid 12% per year just to own this business, and that is before any growth, before any multiple expansion, before any increase in fertilizer prices. If Nutrien simply trades back to a market average multiple of 14 times earnings, the stock goes to $84. That is a 75% return. If potash prices increase by 20% over the next 3 years, which is very possible given the supply constraints and growing food demand, the stock could easily hit $100 to $120. That is a double or triple from here. And here is the best part. You are not betting on some speculative technology or some unproven business model. You are betting on the fact that people will keep eating food. That is it. That is the thesis. As long as humans need to eat, this company will print money. Now, let me address the risks because I am not going to sit here and pretend this is a perfect no-brainer trade. There are risks. Risk number one, fertilizer prices are cyclical. When crop prices are low, farmers cut back on fertilizer spending. We saw this in 2015 and 2016. Potash prices dropped 30% and Nutrien's earnings fell. But here is the thing. Even in the down cycle, the company stayed profitable. It kept paying its dividend. And the stock eventually recovered. If you are investing for the long term, you can handle the volatility. Risk number two, geopolitical issues. Russia and Belarus are major potash producers, and sanctions have disrupted supply in the past. But that is actually bullish for Nutrien. When Russian and Belarusian supply gets cut off from Western markets, prices go up and Nutrien benefits. Risk number three, new supply could come online. But as I said, it takes a decade to build a new potash mine, and with capital markets tight and ESG concerns around mining projects, I do not see a flood of new supply hitting the market anytime soon. So yes, there are risks. But the risk-reward here is heavily skewed in your favor. You are buying an essential business at a beaten-down valuation with a long-term tailwind that is almost guaranteed. If I could only own one stock for the next 10 years, this would be a serious contender. Now let me tell you about the second stock, and this one is even more compelling in some ways. The second stock I would buy in 2026 is Brookfield Renewable Partners, ticker symbol BEP. This is one of the largest renewable energy companies in the world, and it owns and operates hydroelectric, wind, solar, and energy storage facilities across North America, South America, Europe, and Asia. Right now, Brookfield Renewable has about 32,000 megawatts of generating capacity. To put that in perspective, that is enough to power roughly 15 million homes. And the company is growing fast, adding thousands of megawatts every year through new development and acquisitions. Here is why this is the second stock I would own. The world is going through an energy transition that is irreversible, not because of climate activism or political mandates, though those are factors, but because of simple economics. Renewable energy is now cheaper than fossil fuels in most markets. Solar and wind costs have dropped 90% over the last 15 years. Building a new solar farm is less expensive than running an existing coal plant in many places. So, utilities, corporations, and governments are switching to renewables not because they want to save the planet, though some do, but because it saves them money. And that trend is accelerating. Every major corporation is committing to net zero targets. Apple, Amazon, Google, Microsoft, all of them need massive amounts of renewable energy to power their data centers and operations. Governments around the world are mandating renewable energy percentages. The European Union wants 50% renewables by 2030. China is building more solar and wind capacity than the rest of the world combined. The United States passed the Inflation Reduction Act, which is funneling hundreds of billions of dollars into renewable energy projects over the next decade. This is not a fad. This is not speculative. This is a multi-decade secular shift, and Brookfield Renewable is positioned right in the middle of it. Let me give you the numbers. Brookfield Renewable is currently trading at around $26 per share. The stock peaked at $43 in 2021 before the rising interest rate environment hammered all renewable energy stocks. At $26, the company is trading at a significant discount to its intrinsic value. The company generates approximately $1.4 billion in funds from operations annually. That is essentially free cash flow for a renewable energy company. With a market cap of roughly $18 billion, you are getting a 8% cash flow yield. Compare that to the 10-year Treasury yielding 4.2%. You are getting almost double the yield for owning a real business with real growth instead of a government bond. And here is the kicker. Brookfield Renewable has contracts in place for 90% of its energy generation, These are long-term power purchase agreements, often 15 to 25 years, with investment-grade counterparties like utilities and corporations. So the revenue is locked in. The cash flow is predictable. This is not a speculative bet on energy prices. This is a bond-like stream of cash flows with built-in growth. The company has grown its cash flow per share at 10% per year for the last decade, and management is guiding for 10% annual growth for the next 5 years. That means if you buy today at $26 and the company hits its targets, in 5 years, this business will be generating 60% more cash flow per share than it is today. If the stock just trades at the same valuation multiple 5 years from now, which is conservative, you are looking at a stock price around $42. That is a 60% return over 5 years, plus you are collecting a 5% dividend yield every year along the way. So your total return is closer to 85 to 90% over 5 years. But here is where it gets really interesting. I think the valuation multiple will expand. Right now, renewable energy stocks are out of favor because interest rates went up and investors rotated out of growth stocks and into value. But that is temporary. As interest rates stabilize or come back down, which they will eventually, capital will flow back into renewables. And when that happens, Brookfield Renewable could easily trade at a premium valuation again like it did in 2020 and 2021. If this stock trades back to 18 times funds from operations, which it has done before, you are looking at a stock price north of $60. That is more than a double from here, plus dividends. Let me ask you something honest. Are you scared the market will crash again? If you are sitting on cash right now, terrified to invest, comment below what is holding you back and finish with, "But I will win this fight." Sometimes saying it out loud is the first step to taking action. Now, let me talk about why Brookfield specifically, because there are other renewable energy companies out there. Why this one? 3 reasons. First, Brookfield has the best management team in the industry. This is not some startup run by idealistic environmentalists who do not understand finance. Brookfield is run by one of the most sophisticated infrastructure investment firms in the world. They have been doing this for decades. They know how to allocate capital. They know how to manage risk. And they have a track record of creating shareholder value across multiple market cycles. Second, Brookfield has scale and diversification. They operate in 20 countries. They have hydro, wind, solar, and storage. If one region has a bad year, another region compensates. If solar prices drop, hydro picks up the slack. This is not a single project company that lives or dies on one asset. This is a global portfolio of cash-flowing energy infrastructure. Third, Brookfield has access to capital that smaller companies do not. When a distressed renewable energy project comes up for sale, Brookfield can move fast and buy it cheap. When there is a new development opportunity, Brookfield can finance it at lower rates than competitors. That advantage compounds over time, and it is one reason why this company keeps growing while others struggle. Now, let me address the risks because, just like with Nutrien, this is not risk-free. Risk number 1, interest rates. Higher rates hurt renewable energy stocks because these are capital-intensive businesses with long-duration cash flows. If rates stay elevated, the stock could stay depressed. But here is my view. Rates are not going to stay at 5% forever. Inflation is cooling. The Fed will cut rates eventually. And when that happens, renewable energy stocks will rip higher. So if rates are the concern, that is actually a timing opportunity, not a fundamental problem. Risk number 2, regulatory risk. Government subsidies and mandates drive a lot of renewable energy demand. If those policies change, it could hurt growth. But I do not see that happening. The political momentum behind renewables is too strong, even in conservative governments. And again, the economics are working now even without subsidies in many markets. Risk number 3, execution risk. Building new projects on time and on budget is hard. Brookfield has a good track record, but delays and cost overruns happen. That said, this is why I like that 90% of their revenue is already contracted. They are not betting everything on new development. They have a base of stable cash flows, and new projects are just upside. So those are the risks. They are real, but they are manageable. And in my view, the potential upside far outweighs the downside. Subscribe if you want weekly strategies based on 50 years of real market experience. No hype, just what actually works. So now you know the two stocks. Nutrien and Brookfield Renewable. One gives you exposure to the essential need for food. The other gives you exposure to the unstoppable energy transition. Both are trading at discounts to their intrinsic value. Both generate strong cash flows. Both have long-term tailwinds that are not going away. And both are positioned to double or triple over the next 5 years if the thesis plays out. But here is what you need to understand. Buying these stocks is not enough. You need a plan for how you are going to hold them. Because I can guarantee you this, 6 months from now, maybe sooner, one of these stocks is going to drop 15 or 20%. There will be a bad earnings report, or a sector rotation, or some macro event that spooks the market. And when that happens, you are going to panic. You are going to think, maybe Jeremy was wrong, maybe I should sell, maybe I should wait for a better entry point. Do not do that. If you believe the thesis, and you should only buy these stocks if you believe the thesis, then a 20% pullback is a gift. It is a chance to buy more at an even better price. The biggest mistake I see investors make is they buy a great company, the stock drops, and they sell at the bottom out of fear. Then the stock recovers, and they miss the whole move. Do not be that person. If you buy Nutrien at $48 and it drops to $40, ask yourself, did the thesis change? Are people going to stop eating food? No. Then hold the stock. Better yet, buy more. The same with Brookfield Renewable. If you buy at $26 and it drops to $22, did the world stop transitioning to renewable energy? No. Then hold it. Volatility is the price you pay for long-term returns. If you cannot handle a 20% drawdown, you should not be buying individual stocks. You should be in an index fund or a savings account. But if you can handle the volatility, if you can stay disciplined and think long-term, these two stocks give you the chance to build serious wealth over the next decade. Now let me tell you how I would structure this if I were investing real money today. Let's say you have $50,000 to invest. Here is what I would do. I would put $25,000 into Nutrien and $25,000 into Brookfield Renewable. Simple, equal weight, 50-50 split. That gives you diversification between two different sectors, two different business models, two different risk profiles, but both with strong long-term fundamentals. Then I would set up a plan to add more every quarter. Maybe $2,000 per quarter, split between the two stocks. This is called dollar cost averaging, and it is the single best way to build a position over time without trying to time the market perfectly. Some quarters you will buy at higher prices. Some quarters you will buy at lower prices. Over 5 years, it averages out, and you end up with a meaningful position without taking huge timing risk. And here is the key. I would commit to holding these stocks for at least 5 years. Not 5 months, not until they are up 20%. 5 years minimum. Because that is how long it takes for a thesis to fully play out. The fertilizer supercycle does not happen in 6 months. The renewable energy transition does not happen in a year. These are slow-moving, powerful, long-term trends. If you can give them time, they will reward you. But you have to be patient. If you know someone sitting on cash right now, paralyzed by fear, share this video with them. Sometimes people need to hear the right message at the right time. Let me also tell you what I would not do. I would not try to trade these stocks. I would not try to sell when they are up 10% and buy back when they dip. I would not try to time earnings reports or economic data releases. That is a loser's game. The transaction costs, the taxes, the emotional stress, it is not worth it. I have been investing for over 50 years, and I can count on one hand the number of times I successfully timed a trade. It does not work. What works is buying great businesses at fair prices and holding them for years while the fundamentals compound. That is it. That is the whole strategy. It is boring. It is not exciting. But it works. And let me be very clear about something else. These two stocks are not get-rich-quick schemes. If you are looking to double your money in 3 months, go buy lottery tickets. This is a 5 to 10-year wealth-building plan. You buy today at beaten-down prices. You hold through the volatility. You collect dividends. You add to your position over time. And 5 years from now, you look at your account and you realize you made 100 to 200% returns, while most investors were still sitting in cash, waiting for the perfect moment that never came. That is how wealth is built. Slowly, patiently, intelligently. So here's my challenge to you. If you are serious about investing in 2026, if you actually want to take advantage of this once-in-a-decade opportunity, make a decision right now. Are you going to act or are you going to wait? Are you going to buy when there is fear in the market, or are you going to wait until everyone is buying and prices are high again? I have given you the 2 stocks. I have given you the thesis. I have given you the plan. The rest is up to you. And let me tell you something. A year from now, one of 2 things will happen. Either you will look back and say, I am so glad I bought those stocks when Jeremy told me to. They are up 40% and I am on my way to building real wealth. Or you will look back and say, I wish I had listened. I should have bought when I had the chance. Do not be the second person. Be the first. Take action today. Open your brokerage account if you do not have one. Transfer money in. Buy Nutrien. Buy Brookfield Renewable. And then forget about them for 5 years. Let the businesses do what they do best. Generate cash, grow, and compound your wealth. That is the plan. 2 stocks, 5 years, life-changing returns if you have the discipline to see it through. I am 86 years old. I have seen every market cycle you can imagine. I have lived through crashes and booms and bubbles and panics. And I am telling you right now in early 2026, this is one of the best buying opportunities I have seen in decades. Do not waste it. Comment below which stock you are starting with. Subscribe so we keep building wealth together. And if this helped you see the opportunity clearly, hit like and share it with someone who needs it. The market rewards the patient and punishes the fearful. Be patient. Stay disciplined. And I will see you in the next video.